Hello everyone, Steve Lentz here with Discover Options. Welcome to this presentation of 3 different market timing reports in the S&P 500 for advanced options traders. This will be for Friday, August 10th, getting ready for Monday the 13th. Presented material is for educational purposes only. It should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Again, all 3 reports pertain to advanced options traders. They all 3 pertain to the current market condition, and here is the current market condition expressed in 3 dimensions: price action, trend, and the stochastic situation. In terms of price action, Friday was a gap down day. The high of the day was less than what it was on Thursday, than the low on Thursday. And that occurred while we're in an uptrend above the 50-day simple moving average. And in terms of the stochastic, it's in a downtrend underneath its 3-day percent D. The 15.3 stochastic is, and it's between 55 and 100. Okay, so this is all a very unusual market condition, a gap down day occurring in a long-term uptrend, but then contributing to that downswing in the stochastic that we see here. All in all, that's occurred. This market condition has occurred only 12 times since January of 2000. I know it's hard to believe, but you just don't have a whole lot of gap downs occurring in an uptrend when the stochastic is like that. And so that's where it's at. Let's take those 12, and we'll see where the numbers fall. Let's go to the Condor butterfly timing report. Since Jan of 2000, we've had 4,684 closes of the S&P 500, and of those, 65% of the bars have been favorable for selling options premium, where the actual 21 bar subsequent movement was less than what the option prices were implying, as measured by the SIBO's skew-adjusted VIX. Okay, so again, you can randomly flip a coin, 65% chance you're going to end up on a bar that's favorable for selling premium through condors and butterflies. Now, also during that time, as I mentioned, we've had 12 occurrences of our current market condition, and of those, 83.1% of the bars have been similarly favorable for option premium selling. That's a lot higher than the 65%, so we have an implied selling edge of just over 18%. 18%. Now, again, the population that we're looking at, the sample size, is really way underneath what we would prefer. But, we take what we can get, all right? And I'm just reporting the numbers. Keep this in mind, though. It is a small sample size to only 12 out of the 4,684. So take that for what it's worth. I think it's worth quite a bit. I mean, it should give you a bit of comfort in knowing that certainly the vast majority of those worked out well for butterflies and condors. Now, in terms of selling puts, using bull put spreads, credit spreads, and we predicate this on the notion of selling puts, a standard deviation out of the money 30 days away, something like that. So let's look at this. So we've had 4,684 daily closes of the SPX. Of those, strangely, we have the same number, 83.1% of those were favorable for selling put premium in that fashion, where the actual 21 bar downside movement was less than what was being implied by the SIBO's downside skew-adjusted VIX. Okay, so 83% of the time you can flip a coin, and you're going to end up on a bar where the subsequent move was not down a full standard deviation within the 30-day period, 21 bars. Okay, so that's the benchmark, 83%. Now, out of our 12 occurrences, 91.4% of those were favorable. That's much higher than the 83.1, so we have an edge here of 8.3%. Okay, a positive selling edge. But again, remember, it's only 12 occurrences in this case, but it looks pretty good from that perspective. Let's take the same market condition and look at the likelihood report. And we look at rate of change and volatility. And so when we look at the baseline rate of change for the 4,688 occurrences, okay, on average, The 1 week rate of change, 5 bars, is about 0.1% to the upside. But since Jan of 83 or Jan of 2000, we've had on all in all a bullish market with some bearish seasons, but all in all it's been going up. The 2 week rate of change is at 0.2, about 1/5%. 3 week rate of change is at 0.29, almost 30%. 0.3 of a 3%. 0.3 of a percent. Okay. Now, when we look at our current market condition of only 12 occurrences in the past, of those, on average, the 1 week rate of change is at 0.92%, almost a full percent to the upside. Okay. And that's a difference of 0.82. That's a big difference than just 0.1. How significant is that difference of 0.82? We go over here to the z-score, and we see that that represents a full standard deviation to the upside. A full standard deviation to the upside, pretty good. Okay, the 2 week rate of change, on average of those 12, is a 1.18% over a full percent. That's 0.98. That z-score is at 0.85, and the 3 week z-score is at 0.84. Okay, and that's 84% of a standard deviation to the upside. And that's pretty good. I mean, that's significant. What's not significant is this: we only have 12. Okay, now what I've normally done is I break that number of 12 down into those that have where the market has gone up over Friday's high, and then those where it's gone down below Friday's low. And because we're down here at only 5 and 6 occurrences, I'm not even going to cover that. Go ahead and just focus on this. Now, well, even then, out of 5 occurrences, you still have z-scores over a half a standard deviation to the upside. If the market goes down below Friday's low, you have z-scores here that are fairly well flat. But look they're kind of all over the place. Here's one that's half a standard deviation positive. These are less than half a standard deviation to the downside. It's, kind of very volatile in that sense. So focus up here. It looks like this is fairly bullish. Okay, it's more bullish than bearish, that's for sure. Interesting. And that contributes, I think, to what you'll see in terms of the what you've already seen in terms of the edge that the Condor and Butterfly report give us in the bull put spread as well. Now, what's curious here is that the market baseline volatility in terms of realized volatility on an annualized basis between 15 and 16%. Okay, and then for our occurrences in our current market condition, we're right around in the 14% range, a little bit less. Okay, and our VIX right now is underneath that. This would imply that we're not really getting enough premium relative to what the eventual volatility is likely to be if history plays out. Okay, if history plays out. Again, this is the average realized volatility over those 9 occurrences. So, that's just kind of interesting. I think you should take note, and I think with that big gap down, it would seem like the VIX, may have popped up, and it did a bit. And one thing that's interesting is the short-term VIX 9-day kind of almost caught up to the 30-day VIX. Did not overtake it, though. Did not overtake it. And once it does, that's making some implications there. The market is turning more bearish if it does overtake it. But it didn't in this case. I hope this information has been helpful for you, for your trading. Thanks very much for joining us today. Have a great week trading. We'll see you next time. Take care. Bye-bye.